Global markets will open this morning for the first time after Donald Trump unleashed 25% tariffs across the board on imports from Canada and Mexico. He also slapped a new 10% across-the-board tariff on imports from China. Stocks, bond yields and non-US currencies are expected to slide as investors seek safe havens. That's coming up in our 5 Things in 5 minutes. And then in today's bonus deep dive interview, ANZ's head of G3 Economics, Brian Martin, talks to us from London this morning on what exactly these Trump tariffs mean for the global economy and markets.
This time round, it's a much more blanket approach. Everything has been hit.
But first, in 5 and 5 with ANZ, global markets will open this morning to a different type of global economy, potentially with slower economic growth outside of the United States, higher inflation both inside and outside the United States, and higher interest rates globally than would otherwise have been the case. Here's ANZ head of G3 Economics, Brian Martin, talking from London this morning on the likely economic fallout.
Open economies that tend to export a lot, and the US is the largest destination globally for exports from Europe, from China, places. You would expect their growth to weaken, and as their growth weakens, that is disinflationary. It leads to pressure for lower interest rates, and that weakens those currencies.
As of 4 a.m. Sydney Melbourne time, the US dollar index futures were up 0.55%. The Aussie dollar opens at 62.11 US cents, and the Kiwi is at 56.36 US cents. Number 2, global equities are expected to be under pressure as well, as is the US Federal Reserve. Here's Brian again.
So does it mean that US interest rates can't fall as much as they might otherwise would have? In which case, then the Fed could be on hold for longer as they wait to see and digest what the impact of these tariff increases are going to be. And that then could push bond yields higher. And I think for equities, it's not good news. It means a higher input cost for many companies. It could mean slower growth because if prices do rise in the United States, that means that firms' profitability will have to come down to offset some of the tariff increase. Consumers might be able to buy less. As a consequence, I think equity markets could suffer as well. So I do think it's a risk-off safe haven trade.
Number 3. Meanwhile, in New Zealand's economy, consumer confidence fell in January from December, as measured by the ANZ Roy Morgan survey published on Friday. ANZ New Zealand economist Henry Russell points to a soft labour market that is lagging other activity that is starting to recover.
So we did see a slight pullback and it still remains in negative territory, which may be a reflection of the fact that the jobs market is still very loose in New Zealand and consumers are still feeling jobs insecurity fears. But that is likely to change moving forward, though all good things take time. The labour market does tend to lag the broader economic cycle, and while we have seen some positive developments in the very recent data that things look to be stabilising, and it's likely to be a story for a little bit later into the first half of the year when we do see the labour market stabilise.
Number 4. From India, the federal government published its 2025 budget over the weekend, including a smaller deficit relative to the size of the economy and a surprise income tax cut. Here's ANZ economist Dhiraj Nim on the deficit first.
So the Indian government did better than expected. They lowered the fiscal deficit target both for FY25, that is the fiscal year ending March 2025, as well as FY26 by 10 basis points each to 4.8% of GDP and 4.4% of GDP respectively. What this basically highlights is their commitment to fiscal prudence and fiscal consolidation path. And of course, that feeds into their broader agenda to bring down the public debt to GDP ratio.
Number 5. But it was the income tax cut that caught everyone's eyes, as Dhiraj explains.
The great highlight of the budget was how it chose to stimulate the economy, and that was via an income tax cut. So the government increased the threshold limit for income, which is exempt from personal income taxes, by about 500,000 rupees to 1.2 million rupees. And at the same time, it lowered the effective tax rates on various income slabs. Now, effectively, this means the government will have to sacrifice about 1 trillion rupees in direct income taxes, which can be thought of as stimulus to the economy. However, we think that in net terms, the stimulus would add about 0.1 or 1.5% of GDP to private consumption, not more. Having said that, we do recognize that this particular shift in approach to direct taxes was made possible because tax compliance in the economy is rising quite strongly, and we can see that in direct tax to GDP ratio rising quite strongly on account of personal income taxes.
Dheeraj Nim there. Now, in today's deep dive interview, I spoke this morning with ANZ's head of G3 Economics, Brian Martin, in London, about the detail of Trump's historic actions on tariffs and the implications for global trade, global economic growth, and inflation.
In many ways, what he's done is he's thrown cold water over the US, Mexico, Canada, North American trade agreement. And both Canada and Mexico are going to retaliate. And one of the largest trading blocs in the world, one of the largest free trading blocs in the world, is now very much under the microscope as to whether or not it can continue going forward.
Just put into context for us how different this set of tariffs are to the ones Trump brought in his first presidency.
They're really quite different. During the first presidency, what the Trump administration did was that it targeted specific sectors. So it wanted to really ramp up its competitiveness in 5G, for example. So it targeted Chinese companies like Huawei. It wanted to boost its competitiveness in semiconductors. So it developed its trade and tariff strategy around sectors, iron, aluminium, steel. They were all came under the guise of the tariffs as well. This time round, it's a much more blanket approach. Everything has been hit. So not just industrial goods or capital goods, but consumer goods, food, beverages, and indeed other miscellaneous manufacturing. So it's very broad-based, and that is a new departure for this administration from the first administration.
And just looking at the scale of the trade with Mexico, Canada, and China, and how that fits into the overall US economy.
It's enormous. It's just over 4.5% of nominal GDP. So the risk is that some of the supply chains for key sectors in the economy, whether it is the auto sector or indeed oil refineries, that they face disruption from tariffs. So I think that for me is probably almost a bigger risk to the economy going forward if indeed these tariffs prove permanent than the actual tariff itself.
Because when people think of imports, they often think of fully made up, ready to consume consumer goods. But as you pointed out at a note over the weekend, actually there's an awful lot of intermediate goods and other inputs that go into locally consumed or locally put together products, some of which might even end up going back across the border and then come back to the United States.
That's absolutely correct. So there's a lot of cross-border trade. I read an analysis over the weekend that close to $2 million goods and services are traded every minute across the North American continent. So it's absolutely huge. You're right to point out consumer goods are about 25% of the end user imports into the United States. So on that basis, that's why I say I'm not that worried about the inflationary implication of the tariff in the short run. I think the big concern rests much more with supply chains. So there's a lot of goods that are imported for capital purposes. That's, building the infrastructure of US manufacturing, etc. There's a lot of goods, what we call industrial supplies, that are imported as well. And if they face disruption because of the tariffs, well, then that leads to disruption in supply chain. That could lead to some supply issues within the economy. And I think that's where there is a risk, certainly in the short to medium term, if these tariffs prove to be permanent, because businesses will have to adapt how they work.
Brian Martin there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Monday, February the 3rd. Catch you tomorrow with more detail on how global financial markets and America's trading partners have reacted to Donald Trump's across-the-board tariffs on Mexico, Canada, and China. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.